Good afternoon and welcome to Scotia iTrade's webinar. My name is Con Leaf, the Client Education Specialist with Scotia iTrade. I'm pleased to present to you today the 10 biggest mistakes with the market guys. So just before we get started, we're going to just do some quick housekeeping items and then we'll jump right into the webinar. So your sound quality should be good. So you can check this quality by clicking the sound check link in your audio panel of the GoToWebinar toolbar. Of course, the setup window may be on your secondary screen if in fact you're using two monitors. And just be reminded, everyone will be muted for sound quality purposes today. Now, if you're using your computer, you can always call in by using the telephone just in case you're having any audio difficulties with your computer. You can call in using the telephone. Just don't forget to use your access code and your audio pin ID as you see on screen here. And just as a quick reminder, I've got a quick disclaimer for you today. Unless otherwise expressly stated by Scotia iTrade, seminars, webinars, and other educational tools and resources, which is collectively called the content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates don't endorse or approve, not liable for the third party contents, products, or services that's being used. So keep in mind the information provided today will be for educational and informational purposes only. No personal advice, recommendations, objectives are intended for today. And as a quick options disclaimer, keep in mind options does involve risk. They're not suitable for all investors. They're intended for sophisticated investors. So before trading options, please carefully review the options account agreement contained in the Scotia iTrade relationship disclosure document and terms and conditions. I've got a link here on the page, but if you need the actual document, simply go to scotiaitrade.com in the forms library where you'll find that link, or just email me at education@scotiaitrade.com and I can send you a copy of the document. So let's quickly review the toolbars feature. This orange arrow that you see at the top can be used to minimize the GoToWebinar toolbar, or if it's minimized, can be used to open it back up, maximize it. Also, you can view this presentation in full screen mode by clicking on the computer icon in the GoToWebinar toolbar. Now, if you do have a question, you can raise the hand. There's a hand icon there also in the toolbar. Keep in mind, however, that if there's a question, I'll be monitoring the question box. So you might want to just type the question right there, and I'll be able to communicate that over to our presenter today, who will address it as we go through the presentation. Also, today we'll be recording the webinar. So we'll also be emailing you a link to this webinar within one business day. However, should you not receive that link, please feel free to email me at education@scotiaitrade.com and I will have a copy of that presentation sent over to you. Failing that, you can always visit our YouTube channel. We've got a series of archived webinars on our Webinars on Demand playlist, so please feel free to visit our YouTube channel. Just scroll down to the bottom of the scotiaitrade.com website where you'll see the YouTube link. Click on that, go to the Webinars on Demand playlist to find the archived webinars. So you can always, you also be able to download a PDF version of this presentation. I've got it actually included now for you. I've uploaded it to the handout menu in your GoToWebinar toolbar. If you click on that handout section, you will see the PDF version there. You can actually open that up and follow along as our presenter provides the diction. And speaking of, today's presenter is AJ Monte, who is the Chief Market Strategist with the Market Guys. He's been a market technician with over 30 years of experience in the financial industry, currently serving as the Chief Market Strategist for the Market Guy. AJ teaches professionals and novices alike innovative techniques to accumulate and protect wealth. So he's also one of the more recognized financial experts in the industry thanks to his appearances on ABC, Fox Business, and PBS Television. He's authored over 2 financial books and is known internationally for his financial educational seminars. So at this point, without further ado, I am going to pass the presentation over to AJ, who will facilitate the session for the next 30 to 40 minutes, and then I'll come back to wrap up with some closing comments. So AJ, over to you now.
Thank you very much, Conleaf, and welcome everyone to today's presentation. You know, this is a a bit of information that actually falls into the category of risk management. And if you think about it, if we can avoid the most costly mistakes from the very beginning, we're more or less hedging ourselves against that future loss by avoiding those pitfalls. And I will tell you, risk management really falls into many different parts of our lives, whether you're investing in the market or if you're like me living in Florida. We've had a first-hand experience on how to manage risk, especially if you've been paying attention to the news. We got hit with a very strong hurricane, and in fact, right now, I'm operating under generator power. We still don't have power, and that storm hit us on the 10th. So I would say with regard to hurricane management, one of the biggest mistakes you could make is not having a generator or not having one that works. Very serious about that. In fact, I just got off the phone with a local friend who works for a Ford dealership in Central Florida here, and their whole dealership is shut down because their generator is not working properly. So, this risk management can be applied to many different parts of our life, and here, obviously, we're talking about investing and trading. Now, you may have seen on that first slide there with my bio, over 30 years. It's actually been 35 years since I first set foot on the floor of the New York Commodity Exchange in the World Trade Center. And I am not ashamed to admit that I have made all of these 10 mistakes and probably a lot more. I'm only giving you the top 10 mistakes. And each time I made one of those mistakes, it did cost me money. And in fact, my biggest hit ever came in the crash of 1987, when I lost almost everything when the market crashed. And I'll show you how to avoid that mistake that I made, which was extremely costly. And I hope you do take this seriously. And the handout there in the toolbar, again, it's my gift to you. Conleaf and I have gone back and forth to prepare this content for you to make sure it was the best that we could deliver, and I'm very proud to say that we are delivering content that no one else is delivering, at least not to my knowledge. So when you look at mistakes, we're going to obviously make a list here, 1 through 10, marrying your stock and finding trades that aren't there. Well, going back to 1987 and even the crash of 2000, I'll tell you a true story, and this was actually highlighted, I believe it was chapter 5 of my book, where I had a client. I use a different name to protect her identity. I call her Diane, and Diane actually bought a stock that she thought was Yoo-hoo, the drink, the chocolate drink, and she actually bought in error. Her broker bought her ticker symbol YHOO, which was Yahoo. Now, again, true story. Diane she had a $200,000 account, and every time it went up, she used margin money to buy more of the stock. So she kept buying Yahoo all the way up. And this is pre-2000. This is in the late 1990s. And she kept buying, and then she'd make money, and she borrowed money on margin, bought more. And I was actually handling her account at the time when I was with another broker, and her account went from $200,000 to over $23 million. Absolute true story. And she kept it in the stock. Now, just prior to 2000, the charts, the technical signals were giving us signals that the market was getting toppy. It was getting what we call heavy. It looked like there were some signs that we needed to worry about. I got on the phone with Diane, and I said, Diane, I think you should move out of this stock. I think you should protect it. I think you should at least diversify. She had it all in one stock, believe it or not. And she said, no, I love this stock. I love this company. Look at what they've done for me, my grandkids. She bought property with some of the money and took some profits out, bought property in Florida, held on, and literally and emotionally married her position. And if you follow history, you'll know that Yahoo took a big hit after 2000. And not only did she lose everything in her account, but she had it leveraged, and she lost the property that she had borrowed money against in her account to buy that property in Florida. Absolute true story, and that's not the only real life story that I have for you. It would take me hours to go through each and every one of them. My point is, don't make this mistake. If you're investing or if you're trading, and you know there's thousands of stocks out there, you could and should be able to roll out of positions without any kind of an emotional tie to that company, and just roll and protect and get into the next opportunity based on signals that are, again, completely removed from your emotions. And sometimes people get so involved with the stock because maybe they're tied to that stock because it's their industry or whatever it may be. They think they know the industry so well, so when the stock goes down, they just hold on because they know better than the analysts. Now, on the third bullet point right there, technical analysis is subjective enough to allow you to create patterns from just about anything on the chart. And I want to show you as an example what I mean here. By the way, if you have any questions along the way, for those that are listening to us live right now, you can submit questions at any time. Conleaf will be screening those questions, passing them off to me, and we'll take those and work them into the presentation. So again, this is your opportunity to be able to ask me questions if they do come up on any of these slides. Okay, so what am I talking about with regard to the charts could show us basically anything? Well, look at this. Look at this chart right here. Let me see if there it is. Now, I'm going to give you 3 different views in 3 different slides of the same exact stock. Okay? So this is the same stock. You'll notice that when I go from slide to slide, the stock has not changed. But what has changed are the yellow lines. Now, if you've studied a little bit of technical analysis, you should know that drawing lines is something that every technician knows how to do. If you're interested in learning how to draw those lines, plug into some of our other webinars where we actually use the Flight Desk platform, and Conleaf does a great job drawing lines just like this, and you could learn by watching and then doing, and it's really the best way to do. Watch and learn and do. Okay, so there's a term that's used on stocks that move in a sideways direction. You could see that there are 2 parallel yellow lines right there, and you could see also that the bottom line, I'll highlight this in red right here, that bottom line is known as support, and when you connect some highs that are showing back here and you draw a parallel line, that forms what's called a channel. Now, a lot of traders look for channels, and they trade those channels based on where the stock is relative to the channel lines. So you might look at this and say, well, here's a stock, and oh, I see a channel right there. Oh, that's good. Okay, so let me trade that like a channel stock. But then another person looks at the very same stock. Again, see, it's the same stock. That hasn't changed. But another person looks at that stock and says, well, I see a channel, but that channel is going in a downward direction. So is this stock in a downward trend? So they start to accumulate ideas on how to trade that stock based on how they're interpreting the price action. Okay, so now a third person comes along and says, well, I'm not really a channel trader, but what I see higher highs and I see higher lows, and I see these things and my eye is picking this up, so I'm going to treat this as a stock that's in a significant uptrend. So they might trade that stock, again, same stock as the other traders are trading, again, 1, 2, 3 right there, and they might trade it completely different. So why am I showing you these charts like this? Because whenever you're looking at a stock, it's important that you get a plan for that stock ahead of time, and no matter what the trend lines are looking like, you have to make sure that the plan remains intact if or should the stock change its direction and go completely opposite from what you first thought it would do. And that's really, really important that you follow that and make sure you're not following your opinions and then drawing those lines that support your opinion and not so much the actual technical signals. Okay, now mistake number 2 is, again, it's kind of related to marrying your stock, because let's face it, if you are in love with your stock and you love the company that, let's say it's Potash up there, that's a big Canadian stock that ticker symbol POT, I'm just using this as an example, a lot of Canadians get attached to that company because it's a Canadian company. And then you might have a company like McDonald's, again, just an example, where someone who lives next to a McDonald's or maybe even owns a McDonald's franchise is going to marry that company. So what happens is mistake number 1 actually ties into mistake number 2, because when the stock starts moving against you, you fail to accept the loss, number 1, and then the second part of that equation is that not only do you fail to accept the loss, but you kind of ignore it and just hope that things are going to get better. So you see the stock going down, and you're not really using any kind of a risk management plan whatsoever. And so now a small loss, because you haven't put a risk management plan in place, a small loss now turns into a catastrophic loss, because you're just more or less playing the ostrich strategy, where you're just going to forget about that, not look at it, and hopefully one day when you turn your computer back on, it's going to be better. And we all know that that doesn't really follow any kind of common sense, and it's strictly an emotional decision that people make to just hold on. Now, again, I can't see your face. I don't see your names or anything like that, but I think each and every one of us at one point has been in that position where we have made an investment and it goes against us, and you just kind of, you have that wait and see attitude. Again, it could be a stock, it could be a real estate investment you made, it could have been, hey, I'm gonna loan money to a local business person, whatever it may be, and you just kind of ignore the loss. Okay. Now, Nancy says she can't see the chart. Okay. Conley, I'm not on the chart anymore. Did it advance? Did my screen advance? I hope so, because I'm on
the screen has advanced, actually.
It has?
Yeah, it has, yeah. So
okay.
I'm seeing mistake number 2.
Okay, Nancy, you might want to check your connection there and see. I'm on mistake number 2 right now, and I'm advancing to another chart now that says sell at 47. So again, this pertains to mistake number 2. At what point do we take that loss? Now let's say you bought the stock, I don't know, maybe way down at 35 or 37, and now the stock is at 47, and you're trying to make that decision. Do I sell it now? It's up. I'm up significantly. Should I take my profits? So you start to ask yourself that question. And then you go to the charts and you see that the stock is still trading at around 47, but you don't do anything about it. You're happy that it's up, but you do nothing. But now all of a sudden the stock starts going lower, and you say, well, it was at 47, now it's at 43. What do I do? And so again, without that risk management plan in place, you're more or less going along for the ride, and this becomes a very uncomfortable part of your journey here, because now you're looking at the chart, you see the stock has gone down, but you're doing nothing. Now, again, the risk management principles that we are really more or less promoting are based on simple math formulas. I teach and have constructed a principle or a rule called the 1% rule, and more or less what that does is it helps you develop a plan that's based on a percentage of loss, and not on an emotion. So in other words, if I were to take the 1% rule and put it in a sentence, it would basically state, I, and then you say your name, I am not willing to allow the market to take more than 1% of my account value at any given time. So there's things that you can do with regard to getting out or planning an exit strategy that can, if you follow it correctly, can limit your losses to whatever percent you want to set. If it's 1%, you could do it that way. If you want to use a 2% loss, you could do that. And it's not based on the stock price. It's based on what you are willing to lose as far as your portfolio. Okay. Now, Catherine says, so how shall we read the chart, for example, of mistake number 1? Catherine, what I would do is go to the toolbox, download the presentation. It's right there, and save it to your computer. And as long as you could hear my voice, you could advance the slides with me, and I'll tell you when I'm going to the next slide. Maybe that'll help you. Okay, as long as you can hear my voice, that's what's most important, and then you can review this later. Okay, so you'll see that on this chart there's a green line, there's a red line. Those are known as moving averages, and a lot of traders use those as guides for getting in or out of a stock. So let's say you see a stock that's moving towards a moving average, and you say, well, should I sell it if it drops below 43, which would be below that moving average? Well, again, that's a question that you might bring up. But what if you don't have a plan? And now it's trading 39, and you're saying, well, what do I do? Do I sell at 39? You get my point. It was at one point trading 47. Right now, it's down $8 from that high, and you still haven't done anything because you failed to take the loss or take a profit when you were faced with taking a profit. Okay? All right. So now the next slide here is bringing us, again, I'm explaining this for people that are following along with the PowerPoint. I'm now on the slide that is highlighting mistake number 3. Mistake number 3 being doubling down on a losing position. Now, let me just pause here for a second because I don't quite know where the term doubling down or when it was introduced to the general market. I think somehow there was a trader who took a vacation, went to Las Vegas, sat down at a blackjack table and learned how to double down on a hand at blackjack. I don't know. I'm guessing. But doubling down is actually a term used by gamblers. And I'm pointing this out for you because this is certainly not gambling. What we're doing here, trading and investing, we are taking risk. Absolutely. We know that. We are taking risk. However, it's calculated risk, and we are using tools that measure trends, that measure volume, and in learning these skills and how to read the markets at all times, whether you're making a decision to buy or sell, at all times we have to keep risk management in the back of our minds and even at the front of our minds, because we do not want to get in a position where we're doubling down, especially when it's a losing position. Because when you're doubling down on a losing position, what you're doing is you're moving from trading for a profit to trying to trade out of a loss in order to get to break even. Again, if I had the hands, if I asked you to raise your hand, I'm sure a lot of you would raise your hands if I asked you, have you ever tried to double down to get out of a loss? And I'm sure a lot of you would. Again, these are mistakes that I've made before. I did it in silver years ago. Silver dropped. I bought more because I thought it would bounce, and I bought more on the way down. I even tripled down, and I kept buying scale down, hoping that it would bounce. And guess what? Silver never did. And that was my biggest hit in 1987 when the markets crashed. Silver also came down. And for me, mistake number 3 that I'm highlighting for you became my biggest mistake because it was doubling down or scaling down. Every time the stock got cheaper, I bought more shares. And now what happens is that absolutely accelerates your losses on the way down because, again, you're increasing the number of shares. And that's really exactly opposite of what the professional traders do. See, professionals, what they do is they don't double down, they more or less double up, if you want to say it that way. When a stock starts to go higher, the professional traders and the money managers that are managing hedge funds, what they do is they buy on signs of strength. So if a stock breaks out of a new high, they're actually buying more on the way up. Now, obviously, if you're buying a stock at a higher price, you're not going to be able to buy as many shares at that higher price, but you are buying on strength. Doubling down in this mistake number 3, what you're doing is you're actually buying in weakness. And you don't want to be buying stocks when they're weakening. You want to buy stocks when they're strengthening. And that's mistake number 3. Okay, I just moved to the next slide, which shows a chart that really explains or highlights my example. It says, where would you double down? Again, at the top left of this chart, the stock was trading, 52 to 56. You're buying it, it goes down. Now it's trading 40 and you buy more. At what point do you say, okay, enough is enough? Well, that's when it becomes very painful. Now, when you start doubling down on a stock that is going down or trending down, what happens is you will eventually get out. Oh, believe me, I tell you the truth here. You will eventually get out of that position. When? And it's not because the charts are telling you to. You will get out because it becomes so painful to hold it that you just throw your hands up. And you've lost so much money that you just want to run away from the pain and put your trading on hold and not even look at the market after that. That actually is what happens. Unfortunately, people who continue to buy on downward trends, what happens is they actually knock themselves out of the market because they don't want to lose any more money. And what happens is they become afraid of the market now, and then they don't touch it. And it's hard for them to get actually back into the swing of things. Now, point number 4, although it doesn't weigh as heavily as a doubling down concept, one big mistake is the lack of training and preparation. Now, you have to really thank Scotia here because they are giving you free education. They're giving you the tools that you need to learn how to manage risk and how to use the charts, and they help you with options and learning options and things like that, as well as the exchanges. As an example, the Montreal Exchange does a great job educating investors on what options are about, and I'm going to talk a little bit more about that towards the end. But mistake number 4 is, again, people just jumping in because their neighbor told them, hey, you can make money here, and they don't prepare. What I would say is consider putting a small percentage of your portfolio aside for education, whether it be just going to the library or bookstore and buying a book, or investing your time. It doesn't even have to be money. Just investing your time, which is valuable. It has value to it. Your time is money. Put a percentage of that time and money aside so that you can get the training and preparation that you need, and more or less stay in a regular schedule, maybe 2 times a year, 3 times a year, maybe more, where you're going to commit time to learning about the markets. And here's why. The markets are always changing. Each and every month, it seems like there's a new ETF, an exchange-traded fund. Every week or every day, the market conditions are changing, whether it be through a geopolitical event or an economic event. We have to, again, be on top of the news, make sure we have our finger on the pulse of what's going on. And what happens is you become a master of the basics rather than chasing the arcane, which, again, a lot of people are always chasing that fast money. How can I make a quick profit? And again, they don't prepare for what's ahead in the market. So, okay, so I'm advancing the slide from mistake. Next slide. There's no substitute for training. I don't want to be redundant there, but it's absolutely true. There is no substitute. I'm now on mistake number 5, trading with scared money. Interesting, isn't it? What is scared money? Well, remember at the very beginning when I talked about the emotions and how you want to move away from emotions and marrying your stock and not knowing when to get out because you love the company. Remember those emotions? Well, emotions play a very, very big part of the investing and trading process, because if you're trading with scared money, and what this means is if you buy a stock and it goes down and you have not planned to manage the risk, or if you have very little, if any, training on how to manage the risk, you're going to start to get scared because you're losing money. I mean, let's face it. We work hard for our money, and if you're in the retirement years of your life, you've worked hard for your money and accumulating what you have. So when you start losing that money, it's going to play on that emotion, and you're going to start being scared to even invest. You see, and what happens is when you trade with scared money, you force yourself into the market rather than trading with the market. And we talk about the market as if it's a person, right? Well, the market isn't a person. It has no feelings. It doesn't care what you want. You have to be in charge of your own actions. And sometimes the best course of action is to just stop and get your thoughts collected and slowly get back in. I always tell people, if you've taken a hit in the market, don't let that scare you out of the market. Just regroup, go back, review some webinars. Scotia has these all on the YouTube channel. You can go back and review without putting any money at risk at all. You go back, review, rehearse, practice with what we call paper trading money, fake money. And then when you're finally ready to get back in, tiptoe back in. Start slow. Start with small positions. Start with just a little bit of money until you get back into the swing of things. And I think that's the best way to go. Okay, I'm on mistake number 6, so you can advance your slide there. Nancy, if you're following along. Catherine, if you're with that slide, go right ahead. Now, Conleaf and I were going back and forth on this yesterday because, listen, mistake number 6 really pertains to option traders, so I don't want to confuse anyone. That's why we have that option disclaimer in the very beginning. You could go to that website and learn a little bit more about the risks of options and things like that. But the biggest mistakes for option traders is that they fail to realize that you get what you pay for. So in other words, if you buy a very, very cheap option, chances are, and the data supports this, that those very, very cheap options, also known as out-of-the-money options, a large majority of them actually expire worthless. So people, they buy because they're cheap, but they don't realize what the benefits might be or even the risks when they do buy. And volatility plays a big part in how options are priced, as well as how much time is left until the option expires, or current interest rates. Those are just some of the variables that affect option premiums. So if you're going to trade options, don't make mistake number 6, or I should say, before you make mistake number 6, learn about the options, how they move. And bullet point number 3 is I prefer to buy higher delta options as a stock replacement strategy. And so that's my preference, but it may not be yours. And again, the Montreal Exchange is going to have some events coming up online that you can plug into to learn about these option concepts, volatility, and deltas and things like that. I will warn you, actually, options is not a very simple thing to learn. It takes a while to learn it. But again, going back to my point of investing your time and money into learning, I think that the time that you invest in learning is the best investment you'll make, because as you get to learn more about some of these concepts, what happens is your familiarity with it allows you a certain comfort level that removes the fear, brings some confidence into the picture, and when you're trading with confidence and you have a plan and you say, okay, I'm not going to allow the market to take this amount from me or 1% from me or whatever, it's actually a very pleasant experience because you're not really that stressed. Okay, now going to the option, this is one of the slides I just want to put up there. You might wish or may wish to buy an option that is in the money. Take some notes on that, write down in the money so you know what that means, or one that has intrinsic value. And the reason for that, and I say why, because when you buy something that's a more expensive option, with the higher premium, you're buying that intrinsic value. So there's less what's called time value, so therefore you would suffer less time decay. Again, there's a lot of variables there, and I don't want to confuse anybody, but it's something you want to look into. So take that in your notes. What is in the money? Define in the money. Explain in the money. Go ahead, understand that, and you'll see why mistake number 6 is a common mistake, because people tend to buy cheap options instead of the more expensive ones. Okay, folks, we are breezing right through here. I don't see many questions. Ken says, I have a mental block about pulling the trigger on options. Ken, that's okay. What I would say, if you have a mental block on that, then I would say stay away from the option for now, if you especially have a block, because if you're having a hard time picking the strategy or the concept, then spend time learning about it. And here's why. Here's why I recommend people learn about options. Even if they're not trading options, it's good to learn option strategy, because over time you'll understand that options do actually have an impact on the overall market, because those are decaying assets, but they do have an influence on the market as people hedge their positions. So again, even if you're scared of options or have a mental block about options, still try to learn it so that you know how it affects the underlying stock that you're probably trading. Okay? Oh, thank you. Excuse me. Thank you, Ken, for that input. I appreciate that. And okay, no other questions. I'm very happy to say that I can see questions coming through. Last time I wasn't able to do that, so that's good. We got some interactivity there. Okay. All right, now let's go to the KISS principle. I've kind of cleaned that acronym up. KISS stands for keeping it super simple. How about that? There's other versions of that, but I don't like to overcomplicate things. And let me tell you, my brain, if I allow it to wander, I do have a tendency to overcomplicate my thoughts. And the reason for that is I tend to overanalyze. Again, I'm talking about myself here now. My degree is not in finance. My degree is actually in aerospace engineering. And I don't know if we have any engineers on the call with us right now. But think about this. Engineers generally have to look at a model or a structure or a situation. Engineers have to actually find out what could possibly go wrong with that bridge or stock position or whatever it may be. Engineers are always looking at what if it fails and what's my contingency plan. So engineers tend to overanalyze the situation, and in the process of overanalyzing, it makes it complicated. And so I have to force myself actually to embrace the simplicity. And let me tell you, over 35 years, I think I've done a pretty good job training my brain to look at the simple signals rather than the complex. And over time, it's actually helped me quite a bit. Not just with relieving stress, but in the overall performance, in the way I trade. I feel a lot more relaxed when I keep it simple. Fibonacci is actually a mathematician, not a pianist. So when you take these technical signals and you draw lines on them, and you start to look at the picture. What happens is it starts to look like this, right? It starts to look like some kind of a calculus formula, and then you start to get confused. A lot of people do, in fact. I went to a seminar at one time, and a gentleman brought his computer up to the stage on one of the breaks, and he wanted me to give him my opinion on the indicators that he was using. And I was looking at a screen, and I'm thinking I'm a pretty smart guy, but why can't I even find the price action on his chart? What happened is he had so many different indicators and oscillators and Fibonacci numbers and all this noise really on the chart that I couldn't even see the price action. So I told him, go back and embrace the simplicity, clean up some of the signals, get rid of this, get rid of that, look at the price, look at volume, and try it from there. Well, 3 months later, he called me back. He said, you know what? It's made a huge difference because I'm not so distracted, again, by that noise. Now, I'm on mistake number 8, again, for those who are following along with the PowerPoint. And unrealistic expectations. Again, it might seem like a low priority topic to focus on, but it is a mistake, actually. People tend to get into this greed phase, and I'm not saying that as a negative thing. Listen, we are in the markets to make money, aren't we? So to a certain extent, we are interested in making money. You could classify that as a greed emotion. Again, not in a bad way. We're in this to make money, not to lose money. I think it would be foolish to jump in and think, okay, I'm jumping in this because I want to lose money. On the contrary, we want to make money. So emotions are dangerous in trading. So what we have to do is we have to more or less rein in the emotions of I'm going to make 700% returns. I have to really put a little bit of blame on some of the infomercials that you see out there, and even some of the books that are published. Make $1 million in a week's time, whatever the title of those books are. But when you start trying to chase a 700% return and you're shooting for the moon, you're missing all of the smaller opportunities that are coming before you that over time could really rack up to be significant returns. Yeah, you might turn that smaller profit down because you're trying to get a much bigger profit in the next hottest stock. So that's actually a mistake to go that route and set your expectations way above on the super high watermark and then not be able to achieve that, because then you start chasing the high return. Now, as I tell people, if you want to get rich quick, this may not be the best way to do it, but if you want to get poor quick, continue trading while thinking that you're going to get rich quick. Again, it's a little play on words, but it's true. People go to Las Vegas and gamble because they want to get rich quick, and they wind up going home broke. A lot of people do, and that's unfortunate. But again, this is not gambling. It is not at all. It's calculated risk. It's investing using probability and statistics and outcome and all those things you learned in college classes, and again, pulling your emotions out of it. Okay, I'm still scanning for questions. I don't see any. Oh, Ken has a question. Options can tell you if a stock can go up or down. Not necessarily, Ken. However, I have published a paper that talks about the influence options have on stocks, and it was supported by several universities where I actually proved that open interest in options actually has an effect on what's called pinning the stock. So if you want to read about that, send me an email. I'll send you the paper. It's a long read. It's not, I don't write it like Gone with the Wind is written. But if you want to read that, I can send that to you. Just shoot me an email. I'll be happy to. Okay, so let's go to mistake number 9. Boy, we're timing this perfectly. I'm having a good time. I hope you are too. This is important information, and I love sharing the good stuff with folks like you because I think it's really going to help you. Mistake number 9 really has to do with the software that we have been given, which, in my opinion, is totally amazing. I mean, if you go to Scotia, and if any of you have ever used Flight Desk, that is such an advanced piece of technology that I would have given $1 million for that software back in the early 80s. Seriously, I would have. Back in the early 80s, we did not have at all the tools that you currently have to trade. We didn't have computers even that would able to handle the bandwidth for pulling up a chart, let alone putting in a trade. It was crazy. It was all done manually. We'd pick up a phone, write down a trade, put it into the trading floor, wait for an execution. It would take 3 or 4 minutes, and boom, we get a fill. And we couldn't have a computer look at the charts. We had to draw them by hand. You have all of the technology that you would ever need, absolutely, but don't use it as a substitute. So don't think that, okay, this computer is going to tell me which way the stock is going to go. There is no holy grail of black box trading. And even if there was, the black box computer techies that are writing these algorithms, they wouldn't give you that software if you paid them, because it would be making too much money for them. So there really is no deep, dark secrets on how to make money fast in this market. Just don't use it as a crutch. Now, for some people, technical analysis is too easy on most of the advanced platforms. So, like I did in those examples of the 3 slides, it's easy to draw a trend line. Okay, so let's draw one up, let's draw one down, and let's base our opinion on what we draw. You see? So don't make that mistake and use the software as a crutch. Remember that fellow that I told you about that came up to me on the break, came up to the stage? I actually went online and I found a picture of what his chart actually, pretty close what it looked like. And it looked like that. He had all these, the RSI, the MACDs, he had the moving averages, he had trend lines, he had pivot points, the whole thing. And again, I had asked, okay, so now, can you tell me where the price is? And, we joked about that because it was just so convoluted at that point. Don't let the technology distract you. Absolutely not. Okay, now we are on point number 10. We're coming towards the end, and I'm still going to answer questions if you have them. Okay, point number 10 is a mistake, or mistake number 10 is trading without a plan. Now let me tell you a true story, absolute true story. This happened to me at the beginning of the summer. I'm a pilot. I started learning how to fly when I was in college, and when the instructors first teach you how to fly, I don't know if we have any pilots online here, but whether you trust your memory or not, it is always the best thing to use are checklists. A checklist could save your life, because in a state of panic even, or a very stressful emotional state where all of a sudden you're losing power in your airplane, you're not going to think correctly. So you have to go to your plan. So checklists are a very, very big part of flying an airplane. And true story, I had got my fuel tank replaced in one of my planes, and I took it to the mechanic. He did the job. I'm getting ready to fly the plane out of the airport where it was being worked on, and I'm going through my checklist, and I'm running up the engine, and I'm going from left tank to right tank, and then all of a sudden the engine completely dies. My heart literally started to pound out of my chest. Now, I was in a completely safe situation. I was on the ground, and I was doing my checklist, which is a run-up. But here's what happened. The mechanic failed to use his checklist, and forgot to bleed the fuel line. There was air in the fuel line. Now think about that. He forgot his checklist, but if I had forgotten my checklist, I wouldn't be talking to you right now. I'd be crashed in the ground and not surviving that. If I had engine power loss on takeoff, I would have crashed. So I take a lot of what I learned from flying and I do apply it to investing. If you're trading without a plan, it's only a matter of time before you crash. And I'm not kidding. Always put in a plan, write a plan. In the first chapter of my book, I help people write the plan. Write it down. Why are you trading? That's a good question to ask yourself. Why are you doing this? And then when you're in a trade, you always have to be able to ask 3 key questions. Why did you enter the trade? Number 1. Where are you exiting the trade if you're wrong? That's number 2. And then where are your exit points for profit? You have to ask yourself those 3 questions. So when you're writing your plan out and you're just not randomly throwing trades into your trading platform, this is going to help you get a better idea of the direction you're going and whether or not you're succeeding to advance forward in that direction. All right. And above all, point number 3, my bullet point number 3, record your successes and failures and learn from both. I document every single trade that I have ever done for years. I don't just rely on my account statement at the end of the month. What I do is I have what's called a trade blotter that I have done on a simple spreadsheet. Whenever I make a trade, I write down the date, the stock, the price I traded it, and the outcome on every single trade. That's why when people say, AJ, can you prove to me your performance? Yeah, I can. I could go back and show you all my trades. I'll show you the losing trades as well. See, I document the losing trades to make sure that I didn't ride that loss too far, to make sure that I didn't go past my 1% rule. You see, so if you lose on a trade, document it, and then make sure you learn from it so that you're not continually making that same mistake over and over again. You're correcting yourself along the way. And that's really the best thing that you can do. And you know what? I've listed for you here 10 mistakes, right? But you could put those in any order you like. I could have started off the presentation with putting a plan together. That could have been mistake number 1. There's no real order. The point is, these are the 10 biggest mistakes, absolutely the biggest mistakes. So if you are, again, have any questions about any of those slides, you can send them to me. The only thing that I ask is that don't expect a quick turnaround because I get hundreds of emails each day. If you have a question pertaining to this presentation, not a stock, I'm not going to analyze your stocks for you or give you a buy pick or anything like that. But if you have a question on a slide, on any of these slides, type in the subject line 10 mistakes and then send me the question and I'll get back to you. I promise you I will get back to you. I just can't promise it'll be tomorrow. All right, it'll be a little while, but I'll get to you. All right. So I really want to thank everyone for attending this class. Please do yourself a favor and do a big favor to your friends and family. Tell people about this. This is free education. Okay. Tell them, hey, let's go to Scotia. Let's go look at a webinar. Or if you run into somebody who's having a problem with investing, to have them talk to one of the Scotia representatives. And then the Scotia representative could direct them to the YouTube channel for more free education. It's really something that Scotia pays me for, so you don't have to pay me. Scotia pays me to deliver this to you. So it does come free, absolutely free for you. You might as well share it and do someone else a big favor. So that's my presentation. Conleaf, I'm going to pass it back to you so you can tell everyone how to get to the Montreal Exchange webinar and also reiterate how to download this PowerPoint presentation for everyone as a gift. Thanks, Conleaf. I appreciate it. We'll talk to you soon.
Great. Thanks, AJ. There was one question. I'm not sure if you had addressed it from Catherine earlier on. That mistake number 1 in the chart that you showed where there were 3 different ways of reading it. Catherine had wanted, what's the correct way of reading that chart?
Well, the correct way here. Let me go back to. I'm gonna have to scroll back pretty quickly. Okay, so here we go. Catherine, hopefully you could see this, and I'm still broadcasting live there. Again, this is the same stock, but looked at three different perspectives. So here you have a sideways channel. Here you have a downward channel. Here you have an upward trend. Now, I want you to notice something. Again, this would go back to a technical analysis presentation. We've done many of these, by the way, where we talk about trading patterns. Okay, might want to look that one up. Trading patterns for traders. This, if you notice, each one of these positions have something in common. I don't know if you could see it, but you can see that the support level on all of these, the ultimate support is that red line. You see that? The red line is the 200 period moving average. I'm sorry, that's a 50 period moving average, that red line. So if you're looking at a stock and you're not quite sure of the direction, then, but you still want to participate in the stock, you might use the moving average as your way to manage the risk. You see, because on all of these positions, those yellow lines do not go lower than that red line. None of them do. You see that? So presentations that pertain to technical analysis patterns or moving averages are probably the next best step for you, so you can see how to trade a stock like this. There are many other signals on that chart that would lead me to believe it would go higher. I don't have time to go into it, but one of which is a hammer pattern that we talk about in previous seminars. Hammer patterns are very reliable. Bullish engulfing patterns are reliable. So you look at the technical analysis, read the signals based on what you've learned, and then after you've made the decision to take a trade, then you go into the risk management part, which again is driven by the chart. So hopefully my long answer answered your short question. All right. You see any other unanswered questions there, Conley?
Yeah, there was one more, and that was from Robert, and he was basically, the basics of technical analysis, are they support, resistance, price, volume, and trend up or down, any more to the basic package?
Oh, absolutely. Basic technical analysis absolutely covers support and resistance. Those are probably the most basic concepts of analyzing a chart, is finding where support and resistance is. Second part of that, Robert, and you hit the nail on the head, is price and volume. Because price and volume and how they relate to one another also gives us an indication on how strong that support or resistance area might be. So they're all related, and basic analysis, basic technical analysis will cover, and I know I've done it over and over, support, resistance, price, and volume. I think one presentation might be price, the forgotten leading indicator, or it might be volume, the forgotten leading indicator. I forget which one it is, but that would absolutely help you. Yeah, so, and listen, remember, you don't want to overcomplicate it either. Remember the KISS principle. See, if I'm talking about support, resistance, price, and volume, and I don't even have a moving average on the chart, I can still be pretty accurate with forecasting, just using those 4 data points. But when you start throwing more on top of it, like the indicators and the oscillators that I mentioned, that's when it starts to get so complicated that all you're looking for at that point is for a sign that supports your opinion. And that's when things start to go wrong as well. So hopefully that helps you out there.
Great, thank you so much, AJ. I think that was it. Robert says thanks. Ken is saying for the uptrend. Catherine is saying thank you for the detail and explanation. So great, thank you, AJ.
All right.
So I'm going to
take control back right to you. You can take it.
Perfect. Yes. Okay, great. So I'm taking the presentation back over now, and we're just going to do a quick wrap up. Today we're almost at the top of the hour, so let's go through this quickly. So once you exit the webinar session today, you're going to have a short survey that will load in your browser. So we just ask that you let us know how the presentation was today, quality information, etc. And also if there's any other topics or concerns that you'd like to have addressed, any other educational information that we can provide to you, do let us know on the survey. So also, just to mention, the YouTube channel that we have here, if you can't find your webinar that you have there, AJ has quite a number of webinars that he's done on technical analysis. If you can't find them on the YouTube channel, feel free to email me at education@scotiaitrade.com, and I'll send you a copy of the link that you can actually browse that as well. So the two webinars that I'd like to provide coming up next week, AJ will be talking about short selling. Some of the informational education on short selling, and that's going to be Tuesday, September 19th. Feel free to go to our webinar page and register for those. I'll show you where to go right in a minute. And right after that, options, the Montreal Exchange will be providing an option trading mistakes to avoid. So similar to what AJ has mentioned today, with the 10 mistakes, the Montreal Exchange will be diving deep into the option trading mistakes. So that's a great one to be also checking up, a great follow-up to AJ's presentation today, and that'll be Tuesday, September 26th. You can just go to scotiaitrade.com, click on the Education tab, and then under the events calendar, you can see where those webinars are. You can register for them, and I encourage you to attend. I'm sure that the information will be great, and this will be a great follow-up to the presentation today. So on behalf of Scotia iTrade and the Client Education Department, I would like to thank AJ for an amazing presentation, great information, and I'd also like to thank you for being with us today. We appreciate that, and we hope that the information provided has been good as always, and that you'll be with us again going forward. Thank you so much. Have yourself a great afternoon.